Today we have Mr. Robert Karras at the Worldly Wisdom podcast, and he has been an investor for over 30 years. He is the Chief Investment Officer of Vienna-based bank Gutmann, and he found his love for investing and markets in 1990. That year, the Vienna Stock Exchange was in a speculative bubble, the likes of which Vienna had not seen since the 1920s. It was during this time that his lifelong interest in the stock market was awakened. It was an expensive initiation process because the crash because the crash in the early 1990s left the newcomers with heavy losses. However, he fought through and now also writes a weekly newsletter called the Gutmann Viewpoint on a weekly basis, publishing it in German and English. You can follow him on LinkedIn or subscribe to his newsletter. Now that we're done with the introduction, I would like to start by asking you the question, how did you start off into value investing? How did you get interested in value investing? What was your journey? And what ultimately made you join Gutmann and pursue a career there?
Thank you, Rade. Great to be on your podcast. And I'll get into your questions in a second, but I think it's also interesting for your listener and for your audience to learn how we got to know each other, because we both attended the Berkshire Hathaway annual meeting back in May, and we just shook hand there, and you gave me your book, which is here.
Yeah.
And then I asked you for your age, and I hope that's still okay to mention it. Because you told me that you're 15 years old, and I was quite impressed because when I was 15 years old, my mom was still buying my clothes, and I didn't know anything about the world. And reading through your book, I think it's a great compendium of all the different mental models out there about what is important in investing. So I think it's a great referral book, and I think it's a good book for people who want to learn, who want to get into investing, and already have a lot of depth in there. So congratulations to that one.
Yeah, thank you. Yeah.
And so I mean, we met in Omaha, and so obviously one assumes the other is also interested in value investing, and that's the term that Warren Buffett coined. And you mentioned that I started out in the 1990s in Vienna, and that had nothing to do with value investing, really. It was just I was a young man, and I saw that a lot of people are getting rich by not only buying equities. Back then, the stock exchange was already, or the mania was already at the stage where people were buying warrants and call options on Mondays and BMWs on Friday. And I thought, oh, that's a great way of living. I want to do that also. And obviously, that was the peak of the bubble. And the good thing is, if you make your mistakes very early, you have less money to lose. So it's not very wise to do it at the end of a career and then have big money losses. If you're young, you still can recover from it. But Buffett says either people immediately get the value investing idea or they never get it. And I normally never disagree with Mr. Buffett on anything. But on this one, I want to disagree because it took me a long time to get to understand that it's about the value of a business, about the long-term entrepreneurial success, and not about the fluctuations on the stock exchange. So I did a lot of things in between, and I think it's the typical thing when you're young. Often you think, oh, that's a great way to do it, but I want to do it quicker. And then over the years, you find out that's not the right path to try to get rich quickly. And so it was a long journey for me to really focus on the business models and become a long-term investor.
Yeah, even for me, I think when I started for value investing, in the beginning, I think around 2020-ish, there was like a huge like write up, and then I was on Twitter, so I looked at FinTweet and stuff, and then that I didn't really go in the correct direction. People were like, "Oh, buy the stock," and then it just goes to the moon, and then yeah, and then obviously there's greed involved, because if it works for say a few weeks or few months, and then after you just keep on doing it. But then that's not the right strategy, because over the long term, it's not gonna help you. Yeah.
Yeah, I completely understand, because I think in 2020, after the bottom, I think millions of new brokerage accounts were opened in the US, also in Europe. I don't know about India, probably too. And so a lot of new people came into the stock market, and stock prices were going up, and everyone was saying, "Oh, that's easy. So that's a cool
Yeah,
way to
yeah.
make a living." And there was a lockdown, so it was also something to do. But markets are cruel at the end. So quick money is also quickly lost.
Yeah, yeah. I think Buffett also said that we usually make money during bear markets, because at those times we can buy those cheap stocks and really hold them, instead of going on with the hype. So with that, my second question is that you work for Bank Goodman, and it's a family-owned bank. And what's interesting for me is that it's survived for 100 years now, maybe even more, slightly more than 100 years, which is an absolutely like remarkable achievement for any business, because businesses have life cycles, and eventually they are meant to erode, but Goodman has been able to stay at the top for such a long time. So what do you think are some reasons as to why Goodman has been able to survive this long and really withstand the test of time? And has it got to do anything with the culture, the values? What makes them so special?
Yeah, Goodman, you're indeed right. Goodman was founded 100 years ago by the Goodman brothers. And back then in the 20s, it was after the monarchy broke apart in the Habsburg monarchy. And a lot of businesses suddenly needed banking services, because there were different currency flowing around. And some of the big industrial companies or families, they opened their own bank to facilitate that FX trading in a way. So they had to convert the different currencies of the different parts of the former Kaiserreich. And I mean, there was a big disruption during the Second World War, because the Goodmans were a Jewish family, and everything was stolen from them by the Nazis. But then one brother came back, and with the Kahane family, revived the banking license in after the war in 1954. 45, and in 57 the Kahane family took over the majority, and they are still the family is still the owner of the bank. And you're right, there are not many family-owned banks left. I think in Austria there are only 2 or 3. And I always wanted to work for either for myself or somewhere where there's owner management, because that's also something Buffett talks a lot about. There's something different if the management is also an owner, because they think more long term. They're not thinking in how can I deliver the next quarterly earnings, but it's what can I do over the next 5 years, 10 years to grow my business. So I think that's really a competitive advantage, to have the luxury of long-term thinking. But on the other hand, Goodman is not a systematically relevant bank, because then you have a lot of additional regulation. I mean, there's enough regulation, but you also can be sure you have state support, and there are different factors going on. But for a family-owned bank, for us, it's only the clients. So if our clients are happy, and if we deliver a service that is valuable, then we will exist. And if we don't do that, then we will disappear over time. So it's a super competitive environment, and we always have to be on our toes and think about how can we deliver great service to our clients, and what can we do to become better. And I think why has the company survived for such a long time is that it always transformed itself. We are ready to make changes. We're ready to make decisions. And I've never been in an organization or in a bank, so to speak, that takes decisions so quickly. I think that's also a big differentiator to the big banking groups. that there's no politics. Everyone is where they want to be, and we are into this together, and we try to deliver great services to our clients. And I think that's the secret sauce, so to speak, for survival, like any other business, to focus on the client, really.
Yeah. Yeah, I mean it does make sense because at the end of the day for business, your clients are the most important, because you're delivering a service to them. So if they don't exist, you don't exist. And I think the values of sort of patience and long-term thinking, I think you also talked about it in your newspaper. And the analogy you gave there was, I think, of monks in a monastery and how we are similar to them. And really you have to sort of approach value investing with a similar, I think, spiritual path-ish. And also because another thing is these ideas from spirituality and these ideas from such topics have survived for a very, very long time. So which makes them even more, I think, reliable in a sense. So what are some of the key similarities you see as a value investor between these two, I think, disciplines? And what should value investors sort of learn from the other discipline, so that they can get better at themselves? So, some special things as well, like maybe not just patience. There are the, values people talk about less. Yeah.
Yeah, you mentioned my monk analogy, because often you talk to people outside of investing or outside of the industry, and they think it's a very busy job. Where you're always blinking screens, and you're always putting in orders, and a frantic, hectic environment. Because often in the movies you see these trading floors and people shouting. And I just wanted to make the point that our daily life is completely different from that. It's much more like a monk than anything fancy, because most of the time what you do is really reading and learning. And I'm also very cautious with the term value investing, because it means so many different things for different people. So it's not clear what it really means. But I think the common ground is that I think all value investors, they are concerned with the underlying business. So stocks are not only pieces of paper, but the underlying business is important. And you mentioned patience, and I think also what is really a differentiator is that investors that focus on the business, they really want to learn about the business. They want to know as much as possible. I mean, you can never be an insider of the business, because if you're inside the business, you will always know more. And even if you're inside of a business, probably a handful of people know a lot. They can grasp what the business is all about and all the different nuances. And then there are a lot of people who just are part in a certain part of the business and cannot see the entire business. So it's very difficult to have real feel for the business. But if you're outside, you can do, I think there are different levels of how deep you can go. And what has been true 20 years ago is, I think, still true. If you look how many investors actually read an annual report, the percentage will still be quite low. And especially now in this environment or age of artificial intelligence and computing power, everyone thinks I cannot have an edge anyway, because all the information is out there and crunched by computers. But I think that's not true. You still have to know about the business. You still have to read as much as possible. You have to not only read the filings, but see the presentations of the company, try to find out how is management really thinking, what are the values, how do they think about capital allocation. And I think if you go to Omaha, like we two did, and you talk to the people there that have followed Buffett and Berkshire for tens and tens and tens of years, what you notice is that you have a different understanding, because you have so many stones in the whole mosaic that you have a different picture than anyone outside it. Because if you talk then to someone who just started to look at Berkshire, you suddenly realize how little they really know, because there's so much under the surface. And I think this information is important to give you the long-term conviction. And conviction is so important because every business model will have difficult times. And if you haven't done your job and learned about the business enough, then you will fail during this time of loss of difficult markets, of difficult environment for the business, because you will not know, is that just the environment, or is that a long-term thing? Is the business model broken? Is the mode of the business deteriorating? So I think this learning about the business, I think that's the thing that drives me as an investor, and many other people I know, because that's stimulating. That's I mean, that's the only job where you have this gift of learning, where you always can learn something new about something in the world. Because people say, oh, you only learn about the business. But if you learn about a certain business, you learn about how the world works. I mean, it doesn't matter if you look at businesses that sell toothpaste, or if you look at business that do funerals, or if you look at the business that does something in the cloud. These are businesses that really change how we live, how we work. So it touches everyone. So I think, and that's an endless story that will never change. There will always be something to learn, and I think only very few people have the combination of you mentioned patience, yes, then the energy to do the research, to do the studying, and the third thing, also have the passion for it. Because if you don't have the passion for it, if you don't get something out of it that is emotional, then it will not stick. And so that's why I think there will always be very few people doing that, because very few people have that combination, because there are so many other things out there in the world that people want to do. And so that's just natural that it narrows down to a few people.
Yeah. Yeah, and I think regarding Berkshire, I think when you go there, you really learn a lot from these different people, because they all have vastly different experiences of life compared to you. And then I think you get a better overview of what life really is when you talk to these people, like-minded people. And I think that's sort of similar in business as well. I mean, part of the reason why I think we love doing what we do is because of how much knowledge there is about a particular business. And when you learn about a particular business, you learn about how the industry works, how they do what they do, how how really be successful, how they're making money, etc., etc. And that, I think, really helps you a lot. And then you need to have a lot of, I think, core principles, I think, that you have to abide by, regardless of what happens in tough times. So so my question is regarding that, and it is like whether you could walk us through an unsuccessful investment case study where you evaluated a company and invested in it, but it didn't go according to plan, and what exactly went wrong in this, and how did that help you bounce back into the future or stick closer with your principles?
Yeah, I think discipline is very important, and in my role as chief investment officer, I'm not in the daily analysis of stocks anymore within the bank. We have an equity team. It's headed by Christoph, and there are 3 other colleagues that focus on the equity side. And we have a lot of discipline built into the system, how the strategies are managed, and how we look at the different business models, but also how the portfolio is put together. And I think that the advantage as an institutional investor is that you have to formulate all this discipline, because your clients want to know. Some private clients might not want to know, but you have other clients that want to know every detail. So you have to think about a lot. What will you do here? What will you do there? What will you do in that situation? How do you react when money comes in, when money goes out, when business models work, if they don't work, and so on and so forth. So there's a lot of structure, processes, risk management, and discipline built into the system. But then if you ask me as a private client, then every single person might build a structure around them, but they still have to deal with their own emotions and with their own psychological structure. And what I learned over the many years is that initially I was very also as a young man, I was very action driven. So I was also in futures trading at one point. I even ran a fund that did futures trading. So a completely different thing. And now I'm at a complete different spot. So I want to focus on my job and doing the best for our clients. So on my private portfolio, I'm less and less active. So I like to hold positions for a long time and not do anything in the ideal case. So I've been investor in Berkshire since 2008, and I'm not doing anything with it, and also with Markel since 2008, and I just hold these positions. And I feel like a co-business owner of these businesses, and I'm not feeling like I've bought the stocks. So it's a completely different psychological thing for me. But if to talk about a stock that was really a roller coaster for me, I bought PayPal many years ago at a very low price, somewhere in the 30s. And then the stock went up, I think, to over 200 or so. This was such a lecture for me that it's very difficult to really know where a business will go and how sentiment around the business will shift. Because when the whole thing around PayPal started, it was really that we revolutionize how we do online shopping, because online shopping was still in its infancy. And if you think back, it was always a hassle to put in your credit card, and then you weren't sure, can I trust this website to put in my credit card data? So there was one company that offered a solution that would travel with you over the net, and you just had the PayPal symbol, and you felt sure that you'll be fine. And that narrative then over the years shifted to something. It's only a button, and everyone can have a button in the internet, and there will be Apple Pay and Google Pay and so on. And so the jury is still out there how durable the business model really is. But that's if you have a shifting, if the competitive environment of a business is shifting and the stock price around is very volatile, then it gets very difficult, because you see a lot of gains and you hold on to it because you want to be in there for a long term and participate in the business success, and then it all comes down and nearly all gains that you had evaporate again. So that's emotionally challenging. But at the end of the day, I'm not invested in PayPal anymore. But at the end of the day, it's just you always have to figure out if you still believe in the underlying business or not. And that leads me to the most difficult decision, I think, to make is the selling decision, when to sell. And no matter who you talk to, I think everyone says that buying is much easier than selling, because if you buy, then you have a clear idea about what the value of the business and why there's an undervaluation. But if you hold it, then when do you sell? And I think someone like Mohnish Pabrai always sold when his target price was hit. He just sold and moved on to the next thing. But even he said at some points, maybe it would be better to hold these compounders for the long term, because you always underestimate how the business can compound over the long term. So for me, the answer is just to hold on to the stock forever, in a way, unless something changes with the business, and even allow it to become overvalued. And only if it becomes egregiously overvalued, then maybe you sell some or you sell it. But I think also Charlie Munger said he's because there's a contradiction. If you wouldn't buy it at the price, why do you still hold it? Shouldn't you sell it? And he said he can live with the contradiction, that he just holds stocks that become overvalued, because he says the probability to sell at the right time and then to get back in again at a better price it's very low probability. And that's what I really believe also, because even if you look back to Phil Fisher's book, Common Stocks for Uncommon Profits, from the 50s, he says the exact thing, that he says not 1 in 10 will be able to get back in the same stock at a better price, so I think you have to really figure out in what time frame you want to act. And what I've learned for myself is that my time frame always gets longer and longer. I want to be super long term. So the idea is that I invest forever. So I assume that the sum of these stocks will go on to the next generation, because you just keep them. Yeah.
So regarding the selling point, I think the main reason why selling is harder than buying is that you're already invested in it now. And to let go of something you've spent time researching on, you've spent time buying on, and maybe even made money on, is something that's hard to do, because then you think, oh, I put in a lot of effort for this and I got rewarded for it. So maybe just more I could put it in. So regarding that, how do you, I think, handle your personal biases? So I think, for example, Ashwath Damodaran, what he does is he writes down his biases on a piece of paper and then looks at it every single time when evaluating. And I think even a simple thing can make you feel biased, or at that point make a wrong decision. For example, when you're too hungry, when you're tired, when you're too enthusiastic, that affects your thinking. So how do you manage those biases? What are things you do to just detach yourself?
Yeah, that's really an important point, to get to know yourself and then protect yourself from yourself, so to speak. Yeah. What I did probably 20 years ago or so is that I emotions crept in, so I did some buying or selling because of an emotion. And so what did I do back then to have some gap between something that triggers the emotion and my action? So you have to find something in between that gives you time to think and detach you from emotions. And that's also something, interestingly, that Buffett said this year at the annual meeting. They said he and Charlie never made an emotional decision. So
Yeah.
that's a big achievement, because I think most people at some point there's some emotion, but I believe them that they have a setup where that's just not happening, and that's just great. And for me, back then it was that I started using a checklist. It was also back at the time when I think Atul Gawande wrote his book about the checklist manifesto, and Monish and Guy Spear talked about the checklists, and so I looked into that, and I started building a checklist that at the end had over 100 questions. And back then I was also running an equity team, and I forced everyone else to do the checklist. So before we were able to buy a stock, everyone had to do the checklist. And it was not just a checklist where you do checks, but you had to write something there and also give you a reason why you believe that is that. So questions like, what is the mode, and why do you believe the mode is sustainable? Is the mode growing, or is it deteriorating? Are there any other companies that are currently attacking the mode? And all these kind of things, you really also some deep questions where you had to write your reasoning. So people were pissed off to do it. And then the outcome was that everyone had to do, because I mean this was the job. So I as the equity head, I could force them to do it, but it had a negative consequence, because people were putting so much time into it. Then suddenly you had this commitment bias, and because they put so much work into it, they wanted to buy the stock. They said, no, I've done all the work, so I want to have this stock in the portfolio, because otherwise all my work would be worthless. And I never had that, thankfully. For me, it was just a learning experience, and often just by beginning to do the checklist, my urge to buy the stock suddenly went away, because I also saw immediately, as soon as you start reading the annual reports and look at the investor presentations, write down a few things, immediately you also see that there's never a purely rosy picture, because the first emotion that drew you to the stock, why you wanted to buy it, because it's so cheap or the business model is so great, then suddenly if you the moment you start digging, you realize, oh, there's so much more to learn, and it's just one thing I'm seeing here. And then this urge just levels off. So that's very helpful. And it also gives you a structure. And because all of the time I'm investing now is really to think about what we're doing for our clients and how are we positioning ourselves. And so it's a different job I'm doing here, but it's not only my job, it's also my passion. So there's less time to do stock research, but I do it now and then because I think it keeps you grounded in what is really important, and it gives you also a different base with your clients, that you're still an investor yourself. So I think you should never get completely out of that. So recently I started to do my checklist again for one company, just to go through it, and it was really cool because I still like the checklist, and there's nothing special about this checklist. It's just in the beginning we started taking it from checklists that were out there, that some things that Monish or Gatsby or whatever they were in the book. So you come up quickly with a lot of questions, but then we added questions from our own experience, or you add questions that are personally important to you, and but it gives you a structure, because you start reading all these reports, but going through the checklist, said, oh, see, I haven't looked at that, so I still have more work to do. So I think for me, it's not writing down things. I like to write down my thoughts. That's why I do my weekly newsletter. But writing an investing thesis, that's not structured enough. So for me, probably the checklist is a way to write all the thoughts in a structured way. And at the end of the day, it shouldn't give you a false security. It's just a medium to be sure that you have done the work. So I think something like that helps me to be less emotional and not having emotions creep in. And I think there are also much simpler lessons. If you have the urge to do something, you should have the rule that you're not allowed to do it on this day or for that week. Have a certain amount of time pass, then this urge will go away anyway. I like also simple rules like Monish had some years ago. I'm not sure if he's still doing that. He had this rule: if he buys something and the stock goes down, he's not allowed to sell it for 2 years.
Yeah.
And I like the idea because it forces you to do all the work up front, because if I'm now buying, I'm not allowed to sell at a loss for 2 years. So be sure that this is the right thing to own for at least 2 years. So I think simple things like that just move you away from action buyers, from doing too many transactions, and really becoming a long-term investor, being invested in the business for the long run. So I like these simple ideas. The simple ideas are much more powerful, because if you do something super complicated, you'll do it once or twice and then you'll forget about it, because it just bothers you.
Yeah. And then regarding the idea, because in my book as well, I have a checklist. I think chapter 6, chapter 7, around there. Yeah. And I think one quote that really resonates with me is that when you're wearing rose-tinted glasses, you cannot see any of the red flags. So
that's true.
Yeah, so you have to remove those glasses and put them down so that you can see, oh, this is a bad thing. I have to stay away from this. Yeah.
That's true.
With that,
I also saw your checklist at the end, that you also you collected a different checklist of different people. You have the Graham checklist, you have the Buffett stuff, and all the different things. So I think that's already, it's really exhaustive. So very impressive what you put together there. So everyone who wants to know more about should buy your book.
Yeah, I actually refer to them a lot during the checklist process, because I think you get to learn a lot by just observing people who succeeded, and then understanding why they succeeded, and then implementing that bits and pieces that you agree with in your life, because I think that really pushes you forward. And with that, I think we've ran out of time. So yeah, we can end the podcast. Yeah.
Rade, just one thing on also on your book, because your book, as you said, there are so many. There's the whole base is there, and all the different things, and the checklist, and learning. You said learning from other successful people. What I will be interested in is that to see where you're going in 5 years and 10 years, because then it will be the question not because then you have all the base anyway already at such a young age. But then it will be what parts of it will fit to your temperament, and what path will you choose, and then I'll be very interested to hear from you, to see what path you took, and what came out of all of that. What's Rade's path?
Yeah, hopefully it's a path I where I'm successful, and I've got to learn a lot in the journey as well. Made a lot of mistakes and then improve from there. So yeah, we'll see in 5 years.
Thank you for inviting me, and great conversation, and all the best for you, and a lot of happiness and success.
Yep. Thank you.